Todd is from FIIG Securities, and he joins us now from over at the camera there. Mark, interesting move. You can tell us about this war behind the scenes, perhaps, because a tactical move by the NAB. You can imagine that there will still be some criticism it doesn't deliver the whole 25 basis points to customers. Does it get points for still being the best rate amongst the big four?
Hi Brooke, how are you? I think the NAB's taken its divorce proceedings to new lengths. You know, it's got a strategy at foot where it says it doesn't want to be like anyone else, and this is an interesting step it's taking. You'd like to think that 5 basis points is worth an awful lot of money, because there's some real reputational risk at foot when you'll have every politician that can be elected to come out and castigate the NAB after making such a great result last month, and then coming out and saying, look, we need that extra 5 basis points, and pointing to where they're cheaper than everyone else. It's a function of they're cheaper because it's very hard for people to lend money at the moment. You know, the Reserve Bank has spoken about the fact that everyone is looking to save, and so as a consequence, you know, it's hard to lend. That's just life. You know, people aren't taking great mortgages, and we're not seeing an awful lot of turnover in that mortgage space. So, you know, the NAB's taken a very interesting tact, and it'll be interesting the next phase of its marketing strategy around the underlying rate.
Because of course we know on the way up they decided to not raise as much as the other banks, which is why they're still in the better position in terms of the rate they're offering now. But it was interesting, along with delivering only 20 basis points cuts to the variable mortgage rate, it says it's facing higher funding costs because of instability in Europe. Now, to attach that worrying headline to that, I guess we can kind of bring this forward and say, if we get more rate cuts from the RBA, can we expect the others also will not be able to pass on the full amount?
Well, the instability in Europe is a very serious issue, but it also becomes an excuse for any behaviour. So, you know, high funding costs in Europe. Well, okay, you need to provide greater emphasis on why that's higher funding costs, because to my mind, you know, you look like a great credit. So I've looked to lend to the NAB. So the NAB and all the banks have said that they've shifted around their funding costs, so it's more driven by the deposit piece by the local investor. So that went from 52-48 against to 52-48 in favour, and is continuing to grow. So as people get more conservative and look to lend money to the bank as a safe haven, it's difficult to justify constantly that it's Europe that's causing this increase in funding costs when, you know, you're not in Europe, except for, you know, in the London pieces that they've got. But broadly speaking, these are four majors who are not based in Europe saying, would you like to lend me some money? And if I'm a European investor, I'd probably be inclined to want to lend money to those four majors.
Now, what about this Greek referendum? Does this, I mean, is this a game changer? We can make this direct link in terms of these funding markets for our banks. What about kind of game-changing moments? Was that one of them overnight?
Yeah, clearly. I mean, that's an extraordinary move, and I think there's an element that says we get the politicians we deserve. And I'm not quite sure what the Greeks did to deserve these politicians, but at the end of the day, that's a shocker, because you as a parliamentarian have entered into some arrangements with the European Union to say this is what we will then do, and then not having the political will or the ability to win your case, and then handing it back to the people and said, look, you didn't reap the benefit of the leverage through the last 20 years. We now want you to work harder and pay for the excesses of everyone else. That's a very difficult political argument you're going to have. So, yeah, that's made everyone who is remotely involved with Europe want to take a step back and say, hang on, we're back to, you know, phase one, stage one. We're back into a real crisis mode. The North Americans will continue to then say, listen, we better protect our patch.
So you're saying are you saying we are back to phase one?
Well, I think we're back to phase one again, because if you said this is going to be a referendum that will vote on the decisions that you've already entered into, I can't see that you're not back to the beginning. I mean, it's just a very difficult situation to have, you know, voluntarily put yourself into.
So what does that mean for the various asset classes? If you're saying we're back to stage one, that was a whole lot of time and energy wasted on rallies across equity markets. And
yeah, that's right. I mean, you've seen the flight. Everyone's out of equities. It's just a continuation of the same volatility. It's just, you know, people are, you know, if you continue to hit your head against that wall, eventually you just want to stop. So we see big growth in fixed income assets. We see big growth in inflation-linked assets, and there's a relationship between where the FRN, so the floating rate paper, and the fixed rates, they don't get too far apart, so you see spillover into that asset class as well. People just want security of tenure. They want to buy Westpac at 720. You know, people want to get these fixed assets, and you know, I think Telstra at 720 for 2020s. People just want these assets now. They want fixed returns. They don't want to rely on a fund manager saying it'll be all right, because clearly they can't prove that it's going to be all right, because the fund managers have less control over this.
When it comes to if you know, if it's gotten that bad again, that sounds pretty scary to people. I'm just trying to get a gauge of what people should expect, because it was only 2 days ago people could find, and I was reading articles, here's 10 reasons why we have a year-end rally, and if you say, I mean, obviously that's been a game changer, but what sort of ride are we in for here?
The issue becomes the equity piece are always saying that this is an opportunity to buy. It's a consistent theme, and ultimately you're going to find that the readers of these articles are saying, look, I've had enough. So they go to more conservative assets, which means ultimately they fund the four majors. They will continue to lend to those guys in the form of term deposits. They will continue to buy just debt instruments. People will just go for fixed term debt instruments because they don't want to be involved in the market. So before it might have been 25% of your portfolio, you'll now move it into 50% portfolios. You know, we're just seeing a consistent barrage of people coming down the line saying, I want out of equities and I want to be in fixed income assets. So you're seeing the Rabos of the world, you're seeing even senior debt. Some of these levels of senior debt paper is in the sevens. So you know, that's extraordinary numbers from what historically had been very low returns. You're now getting really comfortable returns in debt instruments that you can put the money away and say, look, let's just come back in a year.
So are those opportunities going to be there 6 months down the track, or is this an opportunity for now?
It's an opportunity certainly for now. I think, you know, if we see the RBA looking to ease rates, lower rates over time, you might see that opportunity move from those yields. In terms of the asset classes, they're still around. The interesting thing for us is some of the professionals in the market are looking to take advantage of Greek issues, so European debt they look to buy because they trade very high yields. So they might sell some local infrastructure assets like a Preco or the like. So good quality Dalrymple Bay where you've got a coal loader, those are nice assets. They might want to free that up to get the cash to take advantage of a European crisis. So you know, at this point in time, we have the assets. You know, 6 months from now, if everyone goes into bonds, you know, we'll have to look at some issuance.
Mark Todd, very interesting. Thank you so much. And we'll check in again soon. Thanks, Mark Todd from